Welcome to Lesson 36, T3 Lesson 3. Today we cover stops and take profits, the hardest topic in trading and the most important one. We'll learn how to set stop and take profit levels before you enter, why averaging down when price falls blows up accounts, how to take profits in stages. Keep these rules and you move by plan, not by panic. The same habit that keeps accounts alive through Fed shocks on the S&P 500 or NA. That discipline is the core of long-term results. Drop a comment with a stop-loss story of your own. What mistake did you make? Before every entry, write 3 numbers down: entry price, take profit target, and stop-loss price. Why lock them in first? Once you're in, the fear of watching dollars slip away clouds judgment, the same fog that hits traders on a red Nasdaq open. Draw those levels as horizontal lines on the chart. The lines decide for you, without emotion. Example on the chart in front of you. If you've set an entry, a take profit about 5 to 10% above it, and a stop about 3 to 5% below, tuned to your risk tolerance, is a common starting frame. Think of it like budgeting a Barla 3 coffee habit. Small, fixed, and decided before you spend. This is the most important rule. When price hits your stop, exit with no attachment. Averaging down, buying more as it falls, is strictly off limits. Averaging down is the most common failure pattern. It turns a small loss into a big one. You think, I was wrong, so I'll buy more cheaply, then size balloons. Price often keeps falling, so you buy again. Statistically, beginner averaging down almost always grows the loss, whether the chart is Bitcoin or the S&P 500. A stop is not failure. It's a cost of doing business, like paying rent, so you can show up for the next opportunity. If you sell the entire winner in one click, you can miss the next leg up. Think of a great meal. You don't inhale it in one bite. Taking profit in stages is calmer and safer for your head. Set the first take profit like this. Pick a clear resistance line on the chart, a prior high, or a modest target measured from your entry. Then run a split plan. Sell part of the position at the first zone, another part at the second. Size those slices to your risk tolerance. Trail a stop on whatever is left. That trailing exit raises the odds you ride a real trend further. The same habit long-term trend followers use when momentum stays intact. Honor the stop and losses stay small. 3 or 4 trades that each lose about 2% of the account can usually be repaired by one solid winner. What if averaging down turns one loss into 15 to 20%? Even a 100% to winner afterward takes a long time to climb back. That is the psychological trap. What history shows: traders who keep disciplined stops tend to post better long-run results than traders who keep averaging down through Fed hiking cycles and quiet grind alike. So discipline beats gut feel when the goal is lasting equity growth. Before every trade, check these 3. Did you write entry, take profit, and stop as numbers? Are you ready to execute the moment the stop hits? Did you plan how many stages you'll use to take profit? Only enter after all 3 are checked. It feels hard at first. Repeat the discipline, and the gap widens over time. The same edge accounts that survived 2008 and 2020 kept using. Next lesson: leverage. Without stops and take profits, that topic is dangerous. Quick recap of T3 Lesson 3. Before entry, lock entry price, take profit, and stop as numbers. When the stop hits, exit immediately, no averaging down. Take profits in stages, so emotion stays under control. Those 3 points are today's core. Next up in Lesson 4, leverage and margin. Without stop discipline, leverage is extremely dangerous. This lesson is for education only, not investment advice. Every trade is your own responsibility. Please subscribe and hit like.